Okay, we're all set. Welcome everyone to our monthly Collaberex member workshop. Today, David Haas is our presenter, and he's going to talk about retirement plans for business. He knows that most entrepreneurs put everything into their business, and their retirement plan is often either working until they can't work anymore or selling the business. And that could be a really big mistake, and David's gonna tell us what we can do about it. So, David is a certified financial planner, and he's been doing this since 2012 after a long career as an electrical and software engineer. He graduated with a bachelor's degree from Rensselaer Polytech Institute and received an MBA in finance from Pace University. And we're happy to, and he spends his time hiking, right? Tennis, um, what else?
Pickleball.
Gardening too.
Gardening,
Yes. Okay. Take it
growing,
away, Dave.
growing, growing berries for the chipmunks.
Okay.
That's good.
Okay. It's all yours, David.
All
You've
right.
got the audience.
Thank you. Thank you, Jonathan. Okay. So, whoops. Now I got to figure out how to advance. Um, since Jonathan already introduced me, I'm going to tell you that I forgot to put in a disclaimer slide. So I'm just going to say this is not specific advice for you. It's general educational content. And that's the extent of my disclaimer.
Okay.
So today we're going to talk about why save for retirement and what kind of plans are available. State mandates, which is kind of a new thing, which may be interesting, particularly if you have employees, and tax benefits that you might be able to get for your business by actually having a retirement plan. So, why do you want to save for retirement? Well, one thing is that your business may end up not being worth anything. And that can often happen when your business completely relies on you. Sometimes businesses don't work out how people want them to work out. There are all kinds of reasons. So by saving for retirement all along, you can try to avoid that issue affecting your retirement. And qualified retirement plans are protected against bankruptcy. I have some business owner clients that have gone through bankruptcy because their businesses went through tough times. And in each case, it was before they started working with me. And unfortunately, they didn't save for retirement outside of the business. But if they had, they could have kept it. They could have kept that money. And instead, the bankruptcy really wiped them out and they had to start from scratch. Of course, tax qualified plans help your investments grow faster. You want to diversify your wealth. If you put everything in your business, like I said, your business may not always be doing great. So this way you can diversify your wealth. If you have employees or you want to attract employees, having a retirement plan can help. And maybe, you're of a certain age, but maybe your employee is going to be much younger and retirement savings is more important to them. And there are tax credits for setting up a new retirement plan. So here are some statistics that are interesting. Transamerica, big insurance company, sells annuities. They're saying that 6 in 10 self-employed workers are saving for retirement, which means outside of their business. And they started saving at a median age of 29. And Among them, 75% of them are saving in tax advantage retirement accounts. And then there was a SCORE study. Hopefully everybody's familiar with SCORE, which is I guess it's a quasi-government organization. They're saying that 34% of small business owners do not have a retirement plan for themselves. So that's pretty good because it means a lot of them do. 72% of businesses with 10 or fewer employees do have retirement plans. 21% of small business owners use retirement funds from previous employment to actually invest in their business. I'm surprised that's not higher. And 18% of small business owners plan to sell their business to fund their retirement. I'm surprised actually that's not higher because often when I meet and start working with small business people, that was their plan. So we're going to talk about these different retirement plans, and I'm going to order them from simplest to most complicated. So the simplest is just an IRA. So you don't need to be a small business person. It's not really a business retirement plan, but everybody who can meet the criteria and have earned income, you do have to have earned income from your employment or business, you can have an IRA. And you can have a traditional IRA or a Roth IRA. I'll talk a little bit more about the difference, but the traditional is tax deferred, and doing tax deferred. Oh, actually, this is talking about traditional or Roth, both for IRAs or 401ks. It's the first time I've given this, so it is for IRAs, is for 401ks, and there are actually other retirement plans now that allow the Roth option. So I'll back up a little bit and tell you the difference between traditional and Roth, in case you don't know. So traditional is tax deferred, and that means there's a tax deduction on the contribution, but it is taxable on withdrawal. It's a good deal if you're in a high tax bracket now and your tax bracket may be lower in retirement. By the way, it's not just your tax bracket. Maybe you're living in California, you're living in New York, you're living in New Jersey, high tax states, and you're going to move to Florida for retirement. Well, you're automatically in a lower tax environment when you move to Florida because there's no state income tax. So that counts. Your non-spouse heirs. So if you die with a traditional IRA, your heirs must withdraw and pay the taxes within 10 years of death. This is a relatively new rule. If you have a pretty large IRA or traditional account, it could be a 401k or IRA, then that actually can become kind of a tax bomb for your heirs. So it's something to be cautious about. The Roth, there's no tax deduction on the contribution, but there's also no taxes on withdrawal. For Roth, it's easier to tap before retirement because the rules are typically that you can take out your contributions without a tax penalty. There are some rules to meet for that, but it is easier to tap the Roth before retirement. And your non-spouse heirs can leave it in the Roth for 10 years after death. That's actually a big tax advantage. It kind of extends that tax-free gains that you might get on the investments for an extra 10 years after your death. So Roth has a lot of advantages. So now I'm going to talk about the actual IRA. So it's really easy. You can just do it on your tax return. The maximum is $7,500. Plus, if you're 50 or older, you can put an extra 1,100. These values do go up with inflation, but that's for 2026. And you could do a spousal one. So if your spouse is not working, for instance, doesn't have a retirement plan, you're you have your business and you're earning from your business, you can do a spousal IRA or Roth IRA for your spouse as well. So a couple could put $17,200 away based on one business owner's profit. That's actually not too shabby. There are some income caps and phase outs. Here's a special note for New Jersey. I happen to be in New Jersey. IRA contributions for the traditional IRA are not deductible in New Jersey. A lot of people don't know that. So you have to kind of keep track of that for when you take the money out again, because it also means that traditional IRAs in New Jersey are your original contribution is not taxed when you take it out, and you have to keep track to report it properly. So next on the complexity scale is a SEP IRA. So this is actually a business plan. SEP stands for Simplified Employee Pension. These used to be called KEOG plans. They must cover all employees in a non-discriminatory manner. So it's great if you don't have any employees or your employees are all your family members. But it's important to realize once you do have employees that whatever you do for yourself, you also have to do for your employees. The employer contributes up to 25% of an employee's compensation up to $72,000. So you put that into a brokerage, a SEP IRA brokerage account. The employee can decide to invest in whatever they want to. And maybe, it's only the business owner. Because the self-employment tax has to be deducted, the maximum amount for the business owner is only about 20% of profit, up to $72,000. But a SEP IRA can still be extremely useful. The other nice thing is that you can wait until you file your taxes before you do it. So the deadline is typically April 15th. And once it's in the SEP IRA, any withdrawal rules just correspond to a regular IRA. A few years ago, they did pass the Secure 2.0 law, and that set up the Roth SEP IRA. So there's a Roth flavor of this, but there aren't any mainstream providers. So you can't go to Fidelity, Schwab, your bank, and say, I want to open a Roth SEP. Unfortunately, they have yet to provide that. There are some workarounds, which I put there on the bottom, that you may be able to do an immediate Roth conversion of a SEP contribution. But whether that's good for you depends on what other IRAs you have. So like all IRAs, a SEP is also not deductible for New Jersey taxes. So if in New Jersey, the SEP is not as good as some other forms of retirement savings. Next in complexity is a simple IRA. Simple probably stands for something, but I don't know what it stands for. So the employer can create the simple IRA accounts for each employee, but it's the employee that invests and administers their own account once the money is put in. In this case, the employee contributes up to $17,000. That's the limit. There's a $4,000 catch-up if you're age 50 or older, and you just do that from earnings using a payroll deduction. So because of that, for the SEP, your company has to be profitable. For the simple IRA, your company actually doesn't have to be profitable because you're putting the contributions of your earnings. So if you're a W-2 employee of your own company, the company's paying you. The company itself doesn't have to be profitable, and you can still put retirement savings away. The contributions are tax deferred, just like any IRA. The employer has to either match up to 3% of total compensation. So when you're matching, it's only the employees who are participating that you're putting the money in for, or provide a 2% non-elective contribution. That's for every employee. And you can provide more. So if the business owner is the only employee, of course, then you'll want to provide more possibly, and it could be up to 10% of compensation or $5,000. It's simple. The IRA is simple because there's no special IRS reporting for the plans. Withdrawal rules are the same as IRA rules. And it's an IRA, so it's not tax deductible in New Jersey. So let's talk about 401ks. So 401ks are more complicated. And the first one we're going to talk about is non-solo. So that's if your company has employees. It's more complicated because it's governed by ERISA law. The employer is considered a fiduciary for their employees. So if you do bad things like abscond with the money or not put it away when the employee expects it to put away, or provide really expensive investments and take a cut, and all these things have happened, your employees can sue you for fiduciary lapse. The maximum employee contribution in 2026 is $24,500. And if you're over age 50, you can do an $8,000 catch up in addition. And some new laws, if you're age 60 through 63, you can do an $11,200 catch up. So slightly higher. There is an optional employer match or employer contribution. There can be a vesting period. So that vesting period could be 1 year, it could be 5 years. There are some specific formulas. And you can delay eligibility. So, you have to have worked for me for 1 year. I have a client who's a bar owner. There's a lot of transient employees. They have a 401k so that the bar owner can save for his retirement. And because the employees kind of come and go, he has a 1 year delay on eligibility, so they very rarely become eligible. But there are some who are eligible, and there are some of the employees do participate. You can add an additional optional profit sharing plan, which you can decide as a business owner on a year-to-year basis whether you're going to provide profit sharing, and that can discriminate. So the business owner can get a lot more than the employees in the profit sharing plan. And there are ways to calculate that. But the overall plan has to pass non-discriminatory testing, which I'm not going to go into, but basically the idea is, again, you have to take care of your employees in a similar way to the way you take care of yourself. One way to get around that discrimination testing is to do a safe harbor plan. With a safe harbor plan, the vesting has to be immediate, and you have to either match with a certain formula that I have there, or you have to provide a non-elective contribution of 3%. And then you don't have to do the discrimination testing. So I highly recommend, if you decide on a 401k, to do a safe harbor plan. Much, much easier. There is a IRS 5500 form that has to be filed every year. Once actually the plan has more than 250,000 of assets, I believe it is, then the 5500 form has to be filed. And there's administrative costs for a 401k plan, typically somewhere between $1,500 and $3,000 for a small plan. By the way, the employer usually picks up this administrative cost, but doesn't have to. You can charge the plan participants. Okay, so what if there are no employees? You can still do a 401k. You can do what's called a solo 401k. It is much simpler than the non-solo 401k, but you can't have any employees other than your spouse. You can still do a solo 401k and it can cover your spouse. There's no testing required. Discrimination is not a factor because there aren't any employees. There are free plans available. Schwab, Fidelity, these brokers do have free 401k plans. So there's typically no administrative cost. By the way, the regular 401k plans, the employees could take loans. You can set up your plan to allow loans from the 401k, but the free ones don't allow loans. And there is a 5500 form, which does have to be filed when the plan gets larger, but it's easy. It's called the 5500 EZ form, and it's much simpler. It is still regulated by ERISA. 401k plans, by the way, are highly protected against bankruptcy by federal law. IRAs are usually protected against bankruptcy by state law. It's not quite as strong. So this is true for all 401k plans. If you have an S corp, only W-2 income can be used as a basis for the contributions. A lot of people have, you can choose your business form. I happen to have an LLC for my business, so that's kind of a pass-through business, pass-through form. An S corp is a corporation that elects to be taxed as pass-through. Some business owners like this because they can pay themselves with a W-2. They're on a payroll. And they only have to pay Social Security, FICA, and Medicare taxes on the W-2 income, not on their total business income. So typically they pay themselves a smaller salary. You are supposed to pay yourself a salary that is sort of commensurate with what you're doing. But it's typically on the low side. So then they're putting less into Social Security. So they like that. Disadvantage, you're putting less into Social Security, and that might come to bite you later. Other disadvantage, if you have a 401k plan, you can't put as much away. So some of that was a little bit of an aside. Employee contributions and matching has nothing to do with profits. So it all has to do with just, the payments you're making to the employees, and you have to do it whether you're profitable or not. The employer chooses available investments, and then the employee directs the actual investing. And 401k plans are typically nowadays Roth or traditional. And there are some new rules. Employees who made more than 150,000 in the previous year, the catch-up contributions have to be Roth contributions. Okay, hopefully I haven't bored everybody to death yet. We'll have questions. We'll have, you can ask me anything.
Yeah, David, so since New Jersey doesn't allow you to deduct, then would you recommend then a Roth IRA instead of a regular IRA?
I guess it's tough to make that recommendation. I would say yes, I like Roth. I like Roth better in many ways. But if you're making a lot of money and you're in a high income bracket and you can use a traditional traditional contributions to, for instance, go down a bracket or come below certain thresholds, then traditional is better for you than Roth.
So traditional, though, you're not getting the break up front. You're not getting the deduction.
Well,
So
you are getting it federally. In
oh,
traditional, you're getting that
oh, it's
break
just this.
federally.
Oh, it's just the state
It's the state
tax.
tax.
Okay, never mind. Okay,
Sorry, I should have made that clear.
that's all right. Gotcha.
Yeah, it's just for state tax.
Got it.
Although New Jersey is a high tax state, so it's unfortunate.
Yeah.
It's also an issue because, strangely enough, a lot of CPAs don't know this and don't do it properly. I mean, they know it because they're not taking it off, but when you withdraw later, they should be asking you, okay, were you in New Jersey? Or are you in New Jersey? And if you are in New Jersey, how much of this IRA was contributed as an IRA as opposed to a rollover? Because the
Mhm.
rollover had been deducted. And what were your contributions? And so they can figure out the percentage to exclude from taxes when you're withdrawing. People don't do it right, and then you pay too much tax.
Got it.
So, and I don't prepare taxes. So another thing you can do is a defined benefit pension. So if you have a highly profitable business, this might be good for you. You do have to cover all employees, but you can use formulas which actually discriminate by age or longevity, which allow you maybe to put a lot more in for you, the business owner, than for the employees. In this case, the employer makes all the investment decisions. The employer is guaranteeing benefit payments upon retirement or a cash balance, and the employer has to make the contributions. So doctors, attorneys, those are good businesses with steady cash flow that defined benefit plan might make sense. And the maximum target benefit that you can have is $290,000 a year. So that's a pretty good retirement benefit. This requires actuarial calculation every year for the contribution. It's it is expensive to administer. And it can be combined with a defined contribution plan for even higher contributions. So, if you're making a lot of money, you can have a defined benefit plan plus a 401k. So let's talk a little bit about something also relatively new. State laws are now requiring retirement plans for businesses. And this includes New York and New Jersey. I don't know where everybody here is from. I know some of us are in New York and New Jersey. And they're requiring small employers to either provide their own retirement plan or to use a state plan.
I'm in Georgia.
Yeah. I might have the information for Georgia, but this really matters more if you have employees.
Oh, okay.
But some of the states are saying, even with the first employee, you need to do this. So I have a chart here for the northeastern states. And for New Jersey, they've already adopted this. And for New York, it's 10 plus employees. Part-time counts, but 1099 is typically excluded. And if you have a private plan, it's exempted. So there could be benefits to having the private plan rather than dealing with the state plan. I'll look up afterwards. I'll look up Georgia. So the last thing I want to talk about is tax credits. There are tax credits available for setting up a new plan, some pretty generous ones. So remember I said, for instance, a 401k might cost $1,500 to $3,000 to administer per year. Well, for the first 3 years of the startup of the plan, you might get that totally paid back with a tax credit. Not a deduction, a credit. If there are fewer than 50 employees, you get either $500 or $250 for each eligible non-highly compensated employee. And so the business owner is considered a highly compensated employee, but if you pay, I think it's $150,000 or less to your employee, they're typically non-highly compensated. In addition, there's a tax credit for employer contributions. So that's for your matching or your non-elective contribution, for instance, for a safe harbor plan. So that goes 5 years and it kind of phases out. There's an auto enrollment tax credit. So if your plan is auto enrollment, you get an extra $500 for 3 tax years. New 401k plans, new safe harbor 401k plans have to be auto enrolling. What that means is when the employee is eligible, they're automatically enrolled. They would have to do something to say, no, I don't want to be in the plan. And there's a military spouse tax credit for helping military spouses. So if one spouse is in the military and then the other spouse who's not in the military is working for you, you can get an extra tax credit for the retirement plan. That's all my slides, and I'm happy to answer questions. And they could be on what I just talked about, or they could be on some other retirement planning or savings issue or question that you might have. Happy to take questions, and I'll stop the share. Everybody's speechless.
I have a question.
Sure.
And you didn't mention this, but what's your feeling on the role that annuities play in the context of this whole conversation?
So I was mainly talking about tax qualified retirement plans.
Mm-hmm.
Annuities, here's my feeling on annuities. I'm not one of those guys who says, oh no, annuities are evil and they're terrible and you should never have an annuity. But I think annuities are oversold for things that they shouldn't be used for. So for me, an annuity is for guaranteed income either now or in the future. And an annuity is most useful for those guarantees. I find that they're often sold for tax benefits. And without going into details, I can say there's, the money in the annuity does accumulate tax deferred typically. But there's some more difficult rules when you take the money out. And without the guarantees that certain annuities have, just the tax advantage or the tax aspect of the annuity, you can often accomplish much cheaper outside of the annuity wrapper. So I really don't like annuities when they're sold for tax reasons. But I really like annuities when they're sold for guaranteed income reasons. They can create a pension.
Okay.
Other questions?
David, well, you've been doing this for years, decades. So, what do you suggest to a new business owner just starting out in regards to preparing or building towards um, retirement. Like I feel like this is information. This is valuable information, but I feel like new business owners wouldn't know where to enter into this information.
Um, so I think whatever you do, you need to think about saving for retirement. So in other words, if you're a business owner, you need to think about saving for retirement when you're a new business owner as well. It can be hard to think about that when you're not bringing in very much money. So what you need to think about is what percentage of my income am I going to save for retirement? And just start there. So yes, I should be saving 10, 15% of my income for retirement, but maybe I can't right now. So let's save 5%. And then secondarily, you can look and say, 5%, okay, where am I going to put this money? Maybe that's not very big. I'll put it into a regular IRA because it meets the criteria, it's easy, and it's easily available. So where are you going to put it is the second part. And on the other hand, if it's a new business and maybe it's a bigger business and you're going to have employees and maybe you do want to set up something like a 401k because it'll be relatively cheap if you have employees and you can use the tax credits and you'll have it available for your business. Then once the business becomes more profitable and you're actually paying yourself, you'll be able to take advantage of it.
Thank you.
Okay, sure.
You're on
Bill,
mute.
Bill, you're muted.
if you're talking to us.
Yeah, I was talking to myself again. How tough is the government and regulators on using people as 1099s when they should be using them as W-2s? I know it's gone in and out over the years. I just wondering where it is now.
It depends on the state. So I don't think the federal government is really doing that much.
Mhm.
There's something called the ABC test. I was just looking at this for New Jersey. Actually, Alex Rubin had sent out an explanation of a new law in New Jersey for the ABC test. I don't know whether you're on her mailing list,
Mhm.
but it was interesting. So New Jersey is going to be very strict.
Hmm.
And I would say that unless the person you're hiring as 1099 is doing stuff for more than one company.
Yeah.
So, I hire a marketing company and but they're doing it for 10 other companies or 20 other companies, right?
I
I'm
see.
not worried that they're going to fail the ABC test.
Yeah.
But if I hire an assistant, and I do happen to have an assistant, but my assistant, I W-2 her because I knew she would fail the test.
What is the test?
I would have to look it up.
Oh, I got
I
that.
can,
Okay, that's it.
I could
Yeah.
forward you. I think I might still have what they sent, which I could forward you. But basically, it's about control.
Mhm.
So, are you controlling what the employee is doing?
Oh, yeah.
Controlling things like hours? Are you giving them,
Mhm.
computers, office
Yeah.
space, etc.?
Yeah.
And then, are they doing this for multiple people or
Yeah.
only you?
The multiple people is the easy one, but sometimes they're just doing it for one person and it might be part-time also. Well, what about a part-time employee? Do you have to put them on a W-2 if someone's working for you like 20 hours a week and nobody else?
That's exactly what I do. I have a 20-hour, Christine
Yeah.
works for me 20 hours a week, and I've had her on W-2 for years. And by the way, I've never found that to be a tremendous burden.
Well, it's costing you more in taxes and all, of course, right?
It's costing me more in taxes. Yeah, I guess it's
Yeah,
costing me more in taxes.
yeah,
And you have to give your employee in New Jersey, you have to give them sick time.
yeah. So did you do it because you're just very cautious as a financial person, or did you do it because, they would really get down on you?
Well, I did it because
Yeah,
I like to follow the rules
yeah,
more
right.
or less. And I knew this would be complete, I knew she should be a W-2 employee.
Okay.
And I also wanted her to be dedicated and to work regular hours and, I'm giving, it's, I'm have control, but I have another employee who's a 1099. So he's another financial advisor.
Hmm.
He has his own clients. He sets his own hours.
Hmm.
Believe it or not, the way the law is written, he would fail the ABC test, the new ABC test in New
Hmm.
Jersey. And there's a law that was just passed by the Senate this past week that will exempt financial advisor representatives from the ABC test, like realtors are exempted.
So the realtors would have to be W-2s?
Realtors are 1099s, and
Yeah,
that's apparently written into the law. But they
I see.
skipped financial advisors, so they're putting those in there. Maybe. I mean, it has to be passed by the assembly and signed by the governor. And I have no idea. It was passed in the Senate with, I think, only two no votes, so it seemed to have broad support. I'm sure it'll have broad support in the assembly,
Mhm.
but it's up to the governor whether she wants to sign it, and I have no idea. So yeah, I mean, it's a tricky one. So for me, if I was found guilty of doing anything bad like this, it would be a disclosure in all my regulatory documents forever. I have to be really above board.
Yeah.
Any other questions? Or, it's Collaberex. You can ask me anything.
Okay.
Okay, I have one. So,
Okay.
it's the newbie question. But when you have prospects and you have new clients, what do you wish that they already know about this retirement deal? Or are you wanting them to come and ask you, or do you like now maybe that's not the question I want to ask. Like, what do you prefer your clients know from the foundational standpoint of being a business owner and retirement plans?
I don't, I do work with many business owners, and many of them don't know very much about any of these tax laws. It's not their area. They don't need to know this stuff. Um, that's why they're hiring me,
Right.
or why they thought they were hiring their accountant before me. So for me, it's more about the business owner being diligent with things like their books and um, knowing where they're at and not being all over the place. Those make good clients.
Yeah.
I have some. I had a guy who, I mean, he really needed my help. He was a plumber, wants to sell his business, wants to retire, but he couldn't get through my onboarding process even a little bit because he's so all over the place that he can't provide the information I need for me to help him.
Mhm. Yeah.
So that's the best way for me to put it, is that, a business owner who's really a business person, which means they have some eye on the financials,
Hmm.
at least are willing to hire somebody who will do that for them. They don't have to do it themselves. That could be your first hire as a bookkeeper to do all that for you, because that you're never going to do that bookkeeping. So you might as well hire a bookkeeper who's going to do it. But if nobody does it, then that's terrible.
Yeah, I agree.
Hey, hey, David, you said you don't do returns, that you're financial planning. So if I have a client and they're looking for an accounting firm, and they assume that that accounting firm is going to do taxes and give them some financial planning, when would I refer them to you as versus the accounting firm?
Well, a lot of accounting firms, I mean, the bigger firms, which are the more expensive firms, do offer financial advice.
Okay.
Some of the smaller firms really don't, even though they might say they do. Um,
Mm,
I've got to say that when I've have clients bring in, I always review returns, and then I find a lot of mistakes in returns, and I can't believe that it was actually a CPA who prepared the return.
mm,
But I don't do the taxes. It's not what I do.
mm.
Really, I do personal financial advice, and personal financial planning. It's just the person who I'm advising happens to be a business owner.
Okay.
So it's really outside of my area of expertise to tell a business owner how to manage their business. But it's completely within my area of expertise to tell that business owner how to save for retirement.
Okay. So that personal, that's the key, what I hear.
Yeah,
Personal as opposed to corporate. Got it.
as opposed to corporate.
Yeah.
So now I might try to connect that business owner with other people who will do that.
Yeah.
And I know one or two people who sort of do it all, but the one person I know who I think is really good, she never takes on any new clients because she's completely swamped.
Mm,
So I can never refer anybody to her.
mm.
David or Bill, if you know anyone that needs a great accountant, I hired a new accountant this year who's in New Jersey,
Mhm.
who is unbelievable. It's the best experience I've ever had with an
Great.
accounting firm.
That's
Small
great.
firm. Yeah.
How do you know?
How do I know it's a good experience?
Yeah, I mean, you're obviously having a good experience, but how do you know the results are good? I'm just wondering.
They're consistent with previous returns. So it's a
Okay.
confirmation that they both are making the same determinations. And there's some other questions that I've asked her that I've gotten detailed responses from that are also consistent with how other accountants have treated a similar situation.
Okay. That's good.
And I also know because uh, Kevin referred me to her. Yeah. So yeah. How do you know? How do you know your accountant is ever doing the right job?
Well, they get to David and he can see that they
Uh,
weren't.
Yeah, but I've had many that they are doing a great job. So, I'm not going to tell you every accountant's bad.
Right, 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 right.
There are many that are great, but I've had a few really surprises. Like this person has a CPA and they're doing what? I
Yeah.
mean, I have a business. So this business was an LLC and they're showing W-2 and we were setting up a 401k. So, but they're showing the business owners, of course, working in the business. And the LLC was doing W-2 um, payroll for the business owner. That's a no-no.
Right.
Obviously, the business
It's
can pay the owner, but the LLC can only do owner's draw.
Right. I was like, that doesn't.
it's
Yeah,
right.
it's
It's a pass through. It goes onto their
yeah,
personal
it's a pass
taxes.
through. If it had been an S corp, you would do W-2, but as an LLC, you wouldn't. And they've been doing this for several years. And I'm looking at this and saying, what's your accountant doing? It's crazy. So they have since switched accountants and cleaned all that up. We did the 401k and everything's great, um, but why would a CPA firm do that?
Yeah. That's a
Right.
good.
This CPA firm that I use coordinates closely with with financial advisors.
Mhm.
She's always, who are your other advisors? And they work together.
Yeah, that's good. That's really good.
Yeah, that's what they should.
Yeah. I think they should, that should be it should be like a community of support to the business owner.
Yep. Any other questions? And David is always available. I mean, the last slide, he put in his email address and everything. David, you want to put some of that in the chat? So contact him for anything in his other area of expertise, which he didn't talk about at all, is, I don't know if it applies to us. I don't think so. College planning.
Yeah.
Oh
Yeah.
yeah. I wish I would have known that. Goodness.
Yeah.
Oh yeah.
But if you know people that need that, it's, you know, you have kids that are becoming
Yeah.
college age or you want to plan in advance, it's like planning for retirement.
Right.
And often, I get referrals from people, by the way. So I like to do talks like this because it's not you necessarily. You might not need my services, but you might know somebody who needs my services. So
I have one last question before you get off. What is the flower that's on your logo?
um that is it's a night blooming, it's supposed to be a night blooming cirrus, but it's very stylized. The person who did my logo, the designer who did my logo, I said I want to do the night blooming cirrus, but it's a white flower. And she said, okay, we'll do one, but it can't be white, so it's red
Yeah, well, yeah, for logo purposes.
for logo
Yeah.
purpose.
Mm-hmm. Okay, well, that's all my questions.
So I
David, so
I I I do grow those in my greenhouse.
I know I remember the picture you sent. David sent me when we did the Pets of Collaberex campaign. David sent his pet, which was I think it was the flower, the night blooming cereus.
Yeah. Yeah. Although now my pets are apparently the chipmunks that I'm feeding. So I was sitting there. We had my daughter, and we had a bunch of relatives over, and we have a swimming pool. And I'm sitting there watching this chipmunk running over to my gooseberry bushes, filling its cheeks, and then running out to his hole. And he must have done it 50 times.
Wow.
So,
Oh,
and the
he's
gooseberries are not quite ripe yet because they always pick them before they're ripe. So that's what I do. I grow berries for the chipmunks, and that's
that's
apparently my new pet.
That's a perfect analogy. I mean, here the chipmunk is saving for retirement.
there you go. And knows when to pick it.
The
All
Yes.
right,
chipmunk
guys,
may
thank
not be
you.
saving for retirement. It may be feeding his or her family. I don't know,
Yes. Okay.
or selling on the black market.
Thank you so much. I'm
Nice.
gonna stop the recording now.